Hello again, everybody. Doing it from DRFX Forex Swing Trading. Taking a look at the US Japanese yen. Well, the last time we were taking a look at this pair, I had basically made the expectation that we could have gotten a trading opportunity to trade this short. This was within the context of the formation of this consolidation setup, where the support boundary had already been formed, and we already had one resistance point. So we needed a pair to provide us with a second resistance point to complete the resistance boundary and complete the consolidation setup. This would have required, of course, a move to the support boundary once again, and we were basically expecting that to start with a bearish signal. So as you can see, the market did give us a bearish signal, and so many of you would be wondering why I didn't give you a trade setup to trade the move short. Well, the main reason for this had to do with the fact that last time we took a look at the 4-hour chart, I'd expressed a concern that even though in terms of pips, it's a large consolidation, there are two main reasons why I would not have opted to trade this. One had to do with what I said last time, was that the movements appear to be a little bit erratic and volatile. So as you can see here, the market rallied and then pulled back sharply before U-turning once again. In this case, the movement was not as volatile, but the patterns did not give me the impression that it was going to be, that the movements were going to be very strong towards the other side of the boundary. Another factor also had to do with the fact that these candles are fairly weak. So as you can see here, very small candles, so not very aggressive, so they don't really give it a level of confidence needed to be sure that the movement towards the other side is going to be very strong. So because these candles are weak, they generally tend to be associated with slow and erratic movements on the smaller time frame. So that is a concern that I had. Another one that I had was the distance towards the support target. Now, as you can see here, the market did give a bearish signal here. It broke out of the consolidation as was predicted, and with the daily chart closing with a candle at this area here yesterday, entry would have taken place at this area here. So with an entry at 11 at 112.53, a target of 150 pips, technically speaking, could have been captured. But as you know, whenever I set my targets with regards to trading within consolidation, I generally aim for an area that is comfortably above the support point. The reason for this is that the market generally sometimes has a tendency to pull back without actually hitting the boundary. So that is why I generally aim for a target that is comfortably above the support point. Now this would have been at 11.57, and with an entry at 11.55, that would just be below that 100 pip target. And as you will recall from how I trade, I generally trade to targets that I can capture comfortably. I don't want to target an area or target a movement that is barely going to give me my trading target. I want the area that I'm aiming for to give me a lot of leg room, so to speak, so that I can capture that target just in case the market starts to pull back uh, earlier than expected. So this is why anytime my targets are set, it has to be at an area that I know that I can easily capture my minimum of 100 pips. So this target here ideally should be 50 pips lower. So this should have been at 11. So in other words, or put another way, this support target should have been much lower, so that we could have been, so that the target above that support would be at 11. So that is why, and we could easily have captured anywhere between 100 and 150 pips quite comfortably. So that is why I didn't consider this to be a trading opportunity, because of how close we would have been to that support boundary. There are times when the market does go towards the opposing boundary without pausing here, but it's difficult to know, or almost impossible to know, when that is going to be the case. So it's always better to assume that the market is going to pull back towards at this area here before, instead of actually hitting the boundary. So that's the main reason why I didn't consider this to be a trading opportunity, because the distance towards this area would have been too tight in terms of my trading target. Now, as you recall from how I trade, or the basics, or the justification behind my methodology, has to do with the fact that the reason why I trade and target a minimum of 100 pips and 100 pips comfortably has to do with the fact that what I've noticed over the years with regards to the currency market is that whenever we're trading and we're aiming for a target that is less than 100 pips, it's generally associated with volatility in the market. This is something that I highlighted here, and it had to do with the fact that, generally speaking, trades that offered profit targets below 100 pips were often associated with volatile market conditions and weak setups, making them low probability trades. So even though a 90 pip or an 80 pip or a 70 pip trade is on paper a good trade, the setups and the overall context within which you trade to get those targets are generally low probability setups. So that is why I generally avoid trading scenarios and setups that only allow me to capture 70 or 80 pips. It has to be a minimum of 100 pips and comfortably, because the larger the trading target, the more likely that you're trading a very strong setup and a strong signal. So that is why I generally aim to capture between 100 pips and 200 pips with my trading setups. So anything less than that is going to be risky. As I said, 70 pips or an 80 pips by themselves are good trading targets, but generally they are associated with weak setups that have a lower probability of actually going to those targets. So that is why with swing trading, we aim for a larger trading target, and those larger trading targets are generally associated with stronger setups and stronger signals that have a much higher probability of providing us with our trading gains. So just to summarize this currency pair, trading this would not have been a possibility because we would not have been able to comfortably target 100 pips. Targeting less than 100 pips generally is associated with volatile setups and weak setups and weak signals. So even though on the daily chart we actually have a bearish signal, it is a weak signal. It is one of those that I consider to be a weak candle relative to the large candle and a normal candle. Here you can see an example of a large candle as well as normal candle and another normal candle. So the normal candles are the ones that we would always trade and prefer to trade, and the weak candles and the large candles are generally the ones that we avoid. So those are the main reasons why I would not have traded this. And as you can see here, this was a wise decision to avoid this because of this pullback. So that's it in a nutshell in terms of this pair and in terms of why we didn't trade it.